So in our last class, we dissected the concept of business valuation, and we said that valuation represents the process of determining the economic worth of a business or of a company's share. When you want to determine the value of a company or the value of a company's share, you carry out valuation. And we said that there are several purposes for carrying out valuation. One is for merger and acquisition. When two businesses are coming together or when a company is acquiring controlling interest in another entity, there may be need to value each of the entity. All right. We also said that we carry out valuation for the purpose of estate and tax. Okay. We carry out valuation for the purpose of a litigation or when a company is going for stock exchange listing. All right. If a company wants to liquidate, you also need to determine the economic worth of the company's assets so that you will know how much to sell the assets, okay, at a break-up basis. All right. We also said that when there's shareholders or partnership disputes, you also carry out valuation. So we discussed all of this last time. Not only that, we also talk about the basic requirement, the key requirement for valuation. What are those ingredients you must have available anytime you want to carry out valuation of a business? Because as you have, one day you are going to become, even it's also possible maybe you are working in an organization that are into advisory, whereby in your unit, maybe you have participated in the valuation of a business in the past. Maybe you have contributed, you never can tell. But again, of course, it is expected that one day you may find yourself in that position whereby you may want to value a business. So what are the basic requirements that are needed for the purpose of the valuation? We also discussed it last time. I gave you 10 different points. Okay, I gave you 10 different points that you should look out for. I don't want to repeat that because of time. And then we then begin to talk about, after that, we discussed the various methods of valuation. We talk about asset-based approach. We talk about income-based approach. We also dissected the cash flow based approach of valuation. I think that's where we stopped in our last class. Today, basically, we have calculation to do. We have calculation to do. God help us. Like I said to you last time, all right, at this level, even though, like I mentioned to you, I don't expect that, I don't see the reason why valuation should be part of your syllabus scope at this level, because this should be something as it used to be under strategic financial management, because a whole lot of works are required for the purpose of that. But again, the intention of the institute may be that, okay, maybe they want you to get exposed to the dictates of valuation, so that by the time you get to professional level, you already have the idea. All right. So it will not be as if you are just learning it for the first time. But that notwithstanding, I just thought as a tutor that it will become monotonous, something you have done before, even though, like I also said to you last time, the kind of question you are going to see at this level will be different from the likely question you meet under strategic financial management. At this level, examiner may give you simple question, simple scenario question, unlike professional level, which may be more challenging and all of that. Again, the focus at this level may be kind of a theoretical question. All right. What are the purpose? What are the reasons for valuation? What are the criteria or basic requirements for valuation? That may be some kind of a question that you are going to see. But again, let's leave that on one side. Let's go down to the business of the day. So today we want to Under each of the method, I've explained to you what you need to do. So let us practice them. Let's practice them. All right. So let me see. Now, I will love to solve this illustration number 1 because of the fact that there's a new trend, there's a new development in the banking industry. You know, effective April 1st, 2024. All right. The Apex Bank, that is the CBN Central Banks of Nigeria, roll out a recapitalization requirement for banks. That is, each bank should recapitalize. And of course, it's still on because banks are given two years window. That is effective April 1st, 2024, ending March 31, 2026. The banks are required to meet up with the recapitalization threshold. Some of them have met the requirements. I believe others will also meet up before the due date, before the deadline expire on the 31st of March 2026. But that notwithstanding, as a result of that, you never can tell, examiner can ask you to talk about it, to give us the requirements, the recapitalization threshold for Nigerian banks as it's currently applicable. Okay. Again, even though this it has not become operational until 1st of April 2026, but you never can tell. Let's dive into the question and see how we are going to treat it. All right. So I need somebody to help us read illustration number 1. Yes, let me call on you. Angela, please, can you help us read this question?
All right, sir. Illustration 1. Michelin Bank PLC is a commercial bank incorporated in Nigeria in the early 80s. The head office of the bank is situated in Lagos, and it has a network of branches in all the states of the Federation. The objectives of Michelin Bank PLC are maximization of shareholders' wealth and provision of efficient retail and corporate banking services to its individual and corporate customers. These have been achieved over the past years. Recently, the federal government, through the Central Bank of Nigeria, revised the minimum capital of banks. This condition was to be met by all banks latest 31st December 2005. This forced all the banks to offer to members of the public their ordinary shares for subscription. Michelin Bank PLC, in line with its directive, offered its shares to the public. However, it only succeeded in increasing its capital base substantially, although this still falls below the required amount. The only option that is open to Michelin Bank PLC, if it wants to remain in business, is to amalgamate with another bank with good track record. The bank which comes to mind is Dunlop Bank PLC, which incidentally managed to increase its capital base to 10 billion naira. The board of Michelin Bank PLC is considering making an offer to Dunlop Bank PLC. The offer is to take the form of merger on a share-for-share exchange basis. The new bank to be formed is to be called Tire Bank PLC. Extract from the most recent accounts of the two banks are given below. Both companies retain the same proportion of profits each year and are expected to do so in the future. While Michelin Bank's dividends are expected to grow by 12%, those of Dunlop Bank are expected to grow by 4% per annum. After the merger, that is in 1 year's time, Tire Bank PLC will retain 60% of its earnings, and post-merger dividends growth rate is expected to be 10%. The dividends of both companies have been paid. The required rate of return of the ordinary shareholders of Michelin Bank PLC is 15%, and that of Dunlop Bank is 12%. After merger, this will alter to 14%. Required. What is the required minimum capital for Nigerian banks under the current dispensation? What is the type of integration anticipated by Michelin Bank plc called? If the merger is to take place immediately, calculate market values of the two banks before merger, maximum price Michelin Bank plc will pay Dunlop Bank plc.
Yeah, thank you very much, Angela. Yes, that is a question. Number A, requirements. You are asked what is the required minimum capital for Nigerian banks under the current dispensation. All right. When this question was tested for commercial banks, the minimum requirement was 25 billion naira. Of course, it is still applicable until when the new threshold will become operational. That will be 1st of April 2026. However, to answer these A requirements, the minimum required capital for commercial banks is 25 billion naira. That is what is still operational. That's the minimum. But like I said, effective April 1st, 2026, when the deadline will become operational, when the new threshold will become operational, it has changed, all right? Now, banks have been categorized into three. We have category A, category B, and then category C. For the category A banks, these are commercial banks, okay? Category A are commercial banks, then category B are merchant bank, then category C are the non-interest banks, okay? Under each of them, there are basic thresholds under each category that you should be familiar with, but let me just switch. Let me switch. Please open to the material at your end. Let me switch to the working notes so that just in case you never can tell, examiner can do anything. So you can't predict. Let me just write down something here. Okay. This is solution to question number 1. That's page what? I think that's page
Page 122.
122. Thank you. Page 122. Okay. So, number A requirement, of course, this is for Michelin. Bank. Now, number A requirements, examiner is asking the minimum requirements for commercial banks under the current dispensation, okay? What is the minimum required capital for Nigerian banks under the current dispensation? So like I said, what is currently obtainable for commercial banks is 25 million naira. So to answer this, you can say the minimum required capital. Let me write that. Required capital for Nigerian banks, for Nigerian commercial banks is 25 billion. 25 billion naira. This is what is currently obtainable. However, with the new change, let me just add it. With the new requirements effective Let me just put it there. New requirements. New recapitalization or minimum requirement. Okay. So like I said, banks are now categorized into three. We have the commercial banks. So we have category A, which are for commercial banks. Under the commercial banks, there are three different thresholds. The first one is banks with international authorization. Okay, international authorization. What's wrong with this? International authorization. Okay. For the international authorization, the minimum requirement is 500 billion. So these are the first tier banks like GTB, like Zenith, like UBA, Access Banks. Those are first tier banks in Nigeria. So the minimum requirement is 500 billion naira. Okay. Then after that, we also have national authorization. Okay. You will notice that those banks that I mentioned, the GT, the Zenith, they have operation outside Nigeria. All right. So such banks, their minimum requirement is they can do more than 500 billion. Okay. So for national authorization, so minimum requirement is 200 billion naira. Then we also have regional authorization. Banks with regional authorization. Okay. And their minimum requirement is 50 billion naira. Okay. So these are the category A banks in Nigeria. Then for category B, like I said, these are merchant banks. Category B. They are merchant banks. And then their threshold. Of course, this is just only national. Let me see. Yeah. So what are the threshold under the merchant bank? So we only have one category here, which is national. And the threshold is 50 billion naira. Then the last one is category C. Under the category C, we have non-interest banks. So for the non-interest banks, there are two categories. There are two thresholds, two different thresholds. The first one is national. We have national categorization with the threshold of 20 billion naira. And then we have regional. With a threshold of 10 billion. So these are the new threshold for minimum requirements in the banking industry presently in Nigeria. Of course, all these thresholds will become operational to be effective 1st of April 2026. The direction from the Apex Bank is that the banks should go out, okay, should go out and raise capital for the purpose of meeting up with the deadline. All right. So banks are given 2 years, effective 1st of April 2024 to 31st of March 2026, for them to meet up with the deadline. So effective of April 2026, this threshold will become operational, which means that any bank that could not meet up with the threshold, certainly it is possible that such bank may match with another bank or may be acquired by another bigger bank, or the bank may seek to assist. All right. So this answers the requirement number A of the question. So like I said, what is effective, what is operational as of today is 25 billion naira for commercial bank. Okay, for all the commercial banks, 25 billion naira is the minimum requirement. Of course, most of those banks are worth more than 25 billion, but again, it's just the minimum. So let's move back. Let's go back to the B part of the question. In the B part, you are now asked, what is the type of integration anticipated by Michelin Bank PLC called? All right. Remember, according to the question, we are told that Michelin Bank is making an offer to Dunlop Bank PLC. Okay, it's making an offer to Dunlop Bank PLC. Both of them are in the same industry. They may not be of equal size, but they are in the same industry. Therefore, when a company is merging or acquiring a company in the same industry of similar size, okay, operating in the same industry, that is what we call horizontal integration or horizontal merger. All right, this is called horizontal integration. So to answer that requirement, the examiner is asking you what is the type of integration anticipated by Michelin Bank called. So you then say this is horizontal integration. Let me put it down. Number B. So this is horizontal integration. This is horizontal integration arising when two entities, when two companies operating when two entities, operating in the same industry. Oh no, what's wrong with you? Okay, and of equal size. Of course, no two entities are equal in practice of equal. I don't know why this pen is not writing well. Merging together or merged together. Okay, so that is what is called horizontal integration. All right. So, for example, now in the banking industry in Nigeria, we have Zenith, we have GT, we have Access, UBA, Sterling, and all of that. Let's say, for example, if GT, for example, match with a Sterling Bank, all right? So that means, of course, that is what is known as horizontal merger or horizontal integration. They are in the same industry. They may not likely be the same of equal size, but again, because they are in the same industry, usually this is done to create a kind of a monopoly, all right? But again, there are many of them in the industry. So, all right, so that answers that. Let me change this one to true in words. Okay. Number C. If the merger is to take place immediately, calculate one, market value of the two banks before merger. Pay attention to this. Now you want to determine the value. Remember in my explanation last time, when I was telling you that one of the reasons for valuation is merger and acquisition, right? When there's business combination, especially when there's merger, the two entities will need to value themselves. So company A will need to, what is the worth of company A? What is the worth of company B before they merge together? That's what is known as pre-acquisition market value. Thompson, you are writing on my screen. Stop it. So that is what is known as pre-acquisition, pre-merger market value. Like in this case now, examiner is asking you to determine the market values of the two banks before merger. That is pre-merger market value. That is the market value before the merger. All right. So quickly, let's solve this. Number B, Roman figure 1. Calculating market value.
Number C, sir.
Oh, error of mind. Thank you. Number C. So calculating market value, let me do this with pre-merger. Market value. So like I said, the pre-merger market value is the market value before the merger. All right, to do this, you want to calculate market value. So I need to ask myself, how am I going to calculate the market value? Remember, I told you that there are different methods of valuing a company, isn't it? I gave you asset-based approach, income-based approach, and then cash flow-based approach. So the information in the question will tell you which method you are supposed to use to value the companies. Now, when you look at the scenario painted in this question, you will see that examiner laid emphasis on dividend. Okay, Florence, you are writing on my screen. Stop it. So, examiner laid emphasis on dividend. When you go back to the question, the second to the last paragraph there, you are after the table, you are told that both companies retain the same proportion of profits each year and are expected to do so in the future. While Michelin Bank's dividend are expected to grow by 12%, those of Dunlop Banks are expected to grow by 4% per annum. So you have been given growth rates. You have been given dividend growth rates. You are also given cost of equity, that is minimum required rate of return of the ordinary shareholders. All right, you are given cost of equity. You are given cost of equity. You are given dividend growth rate. So something should tell you that you are supposed to use dividend valuation model. All right. If in the question, the growth rate given to you is the earnings, you are given earnings growth rate. It means that the examiner wants you to use earnings yield basis. But in this particular question, we are going to use dividend yield basis, that is discounted dividend model. All right, because information examiner laid emphasis on dividend. So if that is the case, how am I going to calculate the value of Michelin and Dunlop using dividend yield basis? Of course, I've provided you two different formulas. I said that the market value of a company using dividend yield represent the present value of future cash flows discounted at the dividend yield or cost of equity or rate of return on equity, right? And I said that the future cash flow represent the dividend, right? So because you are given dividend in this and the examiner laid emphasis on dividend in this question, in that case, how are we going to calculate this? The second one, and I said that the value of a company represents the ratio of dividend to dividend yield, depending on whether or not dividend will grow. All right. So in this question, you are given growth rate of dividend. Therefore, market value will be computed as dividend over dividend yield. Remember what I said. Dividend yield is the same thing as cost of equity or rate of return on equity. Now, in this question, of course, this formula is where there is no growth. But in the question, examiner has given us dividend growth rate. Therefore, you need to introduce 1 plus G. I will then say 1 plus G, then dividend yield minus G. G is the growth rate. So this is the formula I provided for you when I was explaining the concept. Therefore, I will then do for Michelin banks. For Michelin, I will go to the question, what is the dividend of Michelin? According to the question, you are given a dividend of 1080. Figures are in thousand, figures are in million. So we are given a dividend out of the profit after tax of 3,240. Dividend of 1,080 is paid out, while the balance is retained in the business. The balance of 2,160 is retained in the business for Michelin. So my focus is not on the retention. My focus is on the dividend. So the dividend amount is 1080 for Michelin. So I will then come here, 1080 is the dividend, multiplied by the growth rate. I need to go to the question, what is the growth rate of Michelin before the merger? What is the growth rate of Michelin before the merger? Give it to me. Are you there? Yes. So you are told that while Michelin Bank's dividend are expected to grow by 12%, so 12% is the growth rate. Therefore, 1 plus 12 will give us 1.12. Then the dividend yield, which is the same thing as cost of equity. Let's go back to the question. You are told that the required rate of return of the ordinary shareholders of Michelin Bank is 15%. So cost of equity for Michelin Bank is 15%. All right. So don't forget, dividend yield is the same thing as cost of equity. You can call it rate of return on equity, cost of equity, or dividend yield is the same. So here is 15%, 0.15, minus the growth rate of 12%. So give it to me. What do you have here? All right, bring out your calculator. 1080 multiplied by 1.12 equal, then divided by 0.03.
40 points.
That's 4320, right?
43.20, yes.
So this is 4320 million. That is approximately 40 billion naira is the value of Michelin. As of today, Michelin Bank is worth 40 billion 320 million naira. Then I will do the same thing for Dunlop. So I'll go back to the question, what is the dividend of Dunlop? Dunlop has 1,115. And then the growth rate of Dunlop is 4%. The cost of equity of Dunlop is 12%. Okay, so growth rate is 4, cost of equity is 12. Okay, here is 1150. Growth rate is 4%. Cost of equity is 12.
1155, sir.
Oh, I tested you. That's a Lambda. I picked the wrong number. Thank you for that observation. Yes, minus growth rate of 4%. So what do you have here? This should give us 1155 multiplied by 1.04 equal, then divided by 0.08. That's 15,015.
15015.
15,015 million. Therefore, the pre-merger market value of Michelin is 40,320,000,000 naira. While that of Dunlop is 15 billion and then 15 million naira. So that is what examiner asks you to do. You can see it's not difficult, but no matter how simple is a question, if you don't know, you don't know, right? So yeah, so we are asked to calculate the market value before the merger, okay? Before the merger, we have done that. Then number 2, you have to determine the maximum price Michelin Bank PLC will pay to Dunlop, okay? The maximum price. All right, so I did not tell you this when I was explaining. I don't know, I can't remember if I tell you. In any case, number 2, C2, maximum price. Let me show you now. Maximum price. So in business combination, when you're asked to determine maximum price, simply put, let me scroll down. The maximum price, let me put it down for you. That person should mute, please. The maximum price represents flood. You are the one making noise. The maximum price represents the difference between the post-merger market value, because this business combination relates to merger. So the post-merger market value and the pre-merger market value of the predator. The predator is the company that makes the initiative. In this case, is Michelin. So, and the pre-merger market value of predator. All right, that is Michelin. Okay, so in this case, that means we need to, since we have post-merger market value, what is the value after the merger? We need to determine it. So the difference between the two will give us the maximum price to pay. Right now, we have determined the pre-merger market value for Michelin, which is 40,320,000,000 naira. So we need to determine the post-merger market value. So I would then say calculating post-merger market value. Post-merger market value. How do you do this? You then go back to the question. Somebody is asked, let me check. What's your message? What question are we showing? Study path, whatever. Okay, so thank you for answering the question. Yes, to calculate the post-merger market value, you need to go back to the question. You are going to go to where you have information about the business after the business combination. So what are the events? What happened after after Michelin and Dunlop banks merged together? So information you have after the merger will give you out. Will show you how you are going to calculate your post-merger market value. That is the market value after the business combination. That's the post-merger market value. So it is the same formula you are going to use. The only difference is just that you are using information after the business combination. So to do this, I will then go back to the question, how am I going to calculate the post-merger market value? Okay. Examiner has told us in the last paragraph that after the merger, that is in 1 year's time, Tire Bank PLC will retain 60% of its earnings, and post-merger dividend growth rate is expected to be 6%. So, out of the profit after tax of the combined businesses of both Michelin and Dunlop, when you go back to the question, you will see that the profit after tax, which is the same thing as earning, please, in this question, the examiner has given you profit after tax. Okay, for both companies, you're also given retained earnings. Retained earnings and profit after tax are not the same. Out of the profit after, when you say profit after tax, it simply means earnings, right? So out of the profit after tax, a certain amount is paid out as dividends. So what is retained in the business for growth and expansion that's your retained earnings. So it's not the same thing as earnings. So we have retained earnings, then we also have the total earnings. So in this question, examiner is saying that 60% of the Tire Bank will retain 60% of its earnings. First thing first, you need to determine the total earnings by adding up the earnings of Michelin plus the earnings of Dunlop. You add the two together, that will give you the total earnings. Then you now, if you are retaining 60%, that means you are paying out 40% as dividend. You know, we are using dividend yield basis for our valuation. So if out of 100% of your combined profit after tax, after the business combination, if you are retaining 60%, it means that you are going to pay out 40% as dividend. Okay, so dividend, profit after tax for Michelin is 3240, then 1540. So to do this, to calculate my post-merger market value, I need to determine my total earnings. So I will then come here. I will say earnings. Like I said, earnings is the same thing as profit after tax. So for Michelin, the earnings of Michelin Bank is 3240. 3240. Let me push it back a little bit. Figures are in million. 3240. So earnings of Dunlop Bank is 1540. When you add the two together, that will give us 4780. This represents the total earnings. Examiner now told us that, okay, out of the total earnings of 4780, 60% is retained in the business. So it means that 40% will be paid out as dividends. So I can then come here, post merger dividend. would then be equal to the total earnings of 4,780 multiplied by the percentage paid out, which is 40%. That is, out of the 100% of the earnings, 60% is retained. So it means that 40% is paid out as dividend. Okay, so 4,780 multiplied by 40. What do you have?
1912.
1912.
1912 million. Okay, 1912 million. Let me put naira there. So this represents the post-merger dividend. Now that you have the post-merger dividend, I can then proceed to calculate. Not only that, the post-merger growth rates. Post-merger growth rates. According to the question, we are told is, let me check, is it 15 or
10%.
10%? Yeah, thank you. So post-merger dividend growth rate is expected to be 10%. And then after merger, this will alter to, so the cost of equity after merger will alter to 14%. Okay? So growth rate is 10%. Dividend yield or rate of return R will be equal to 14% after the merger. All right. So if that is the case, now that you have all the variables that you need, I can then say the post-merger market value, post-merger market value. Market value will be equal to dividend of 1912 multiplied by post-merger growth rate, which is 10%, so plus 1, that's 1.10, divided by post-merger dividend yield or cost of equity, which is 14%, 0.14, minus growth rate of 10%, 0.10. So you can see it's not difficult. Just know how to interpret the scenario. Okay, so what do we have here? 1912.
52,580.
2 what?
52,580.
52,580 million. That's it. That's the post-merger market value. This is not what examiner asks you to do. In the question, examiner is asking you to determine maximum price Michelin Bank PLC will pay Dunlop Bank PLC. And we said that the maximum price to pay represents the difference between the post-merger market value and the pre-merger market value of the predator. So in this case, I would then say maximum price. We have calculated post-merger market value and then the pre-merger market value. So the difference between the two will give us the maximum price to pay. So figures are in million. I will then come here post-merger market value. We got 52,580 million. Then the pre-merger, let me write it. Pre-merger market value of Michelin. Michelin Bank is the predator. Is the one that make the initiative. So the market value of Michelin is 43.20. Let me write it. 43.20. So what's the difference between the two?
12,260.
12,260. Okay, so this is the maximum price. So I can now put it in words to say the maximum price that Michelin Bank we pay Dunlop Bank is 12,260 million naira. Okay, that's the end of the question. So anytime you are asked to calculate maximum price to pay, this is how you are going to do it. When you look at my explanation here, you see maximum price represents the difference between the post-merger market value and the pre-merger market value of the predator. The predator is a company that makes the initiative, is a company that initiates the merger. In this case, it is Michelin Banks. All right. So that is end of the question. Let me know if you have any question. Other than that, we'll move to another illustration quickly. All right. So
please, sir, kindly
then,
go back to the last comment. Good evening, sir.
good evening. Yeah. So let's have another illustration. Do you want me to switch? Are you done copying? Don't worry, I will share the document later on. So let me stop sharing and move to the
Michelin Bank
question.
with Dunlop. This is your English. The Michelin Bank with Dunlop.
What?
The
Oh,
price
I
that
said the maximum price that Michelin Bank we pay. I wanted to, we pay to,
John they see why.
don't mind me, Jare. We pay to Dunlop. Let me shorten this. Yeah, thank you for the observation. I didn't know. I was communicating with Page, but meanwhile, I wrote something different down. Okay, then. So let me stop sharing this and move to the question. Let's have another one. Okay. Now, let's have a question that involves asset-based approach, price-earning ratio. How do you treat it when you're asked to value a business using asset-based approach and then price-earning ratio? How do you treat it? So, yes, I need somebody to help us read. I don't know if Angela is still in the class. Please, if you are, kindly read again. Illustration 2. Right, thank you.
Okay. The entire share capital of Wazobia Limited, an unlisted company, is held by the three directors of the company, Chief Oyomesi, Balogun, and Akogun. They have decided to sell their shares in order to complete a divestment proposal agreed with management and as such, wish to know the likely value of the shares before approaching prospective buyers. Should they fail to get buyers for the shares, the company will go into liquidation. The following information is provided in respect of the company: the statement of financial position,
Sir, we have treated this question in the class, sir.
I'm also looking at
Pardon?
it. The name sounds so
Well,
familiar.
I've treated this class in this question in the class.
No worries. I've not treated the online student. I've not enjoyed it. The
Okay.
solo student, I've not
Okay,
enjoyed
let's
it.
go
So
again.
go ahead.
Okay. Extracts from the published statements of profit or loss and other comprehensive income for the last 3 years as follows. It was discovered that inventories were overvalued at the end of 2008 by 600,000 naira. The directors have increased their remuneration in order to reduce the company's tax liability. A realistic charge for services rendered would be 1,875,000. The equipment is old and it is in need of replacement. The annual depreciation, based on current replacement cost, is in the region of 3 million naira. Each of the directors expressed different opinions on the valuation method to be adopted. To Chief Oyomesi, it is most appropriate to value the shares on the basis of price-earnings ratio. For this purpose, he argues that earnings should be defined as the average reported profits for the last 3 years after making proper charges for depreciation and directors' remuneration and correcting the error made on inventories in 2008. In his own opinion, Balogun recommends breakup basis using liquidation values as provided by experts. Akogun, on the other hand, believes that dividend yield basis used, with available data obtained from two similar but listed companies where he is a shareholder. The relevant data of the two listed companies engaged in similar line of business as Wazobia Limited are as follows. Figures obtained from experts for items appearing in the Statement of Financial Position of Wazobia Limited as at 31st December 2011 are as stated below. You're required to compute the value for the entire share capital of Wazobia Limited using price earnings basis, with earnings computed on the basis proposed by Chief Oyomesi, liquidation breakup basis, replacement value basis, and dividend yield basis. Note: assume you are making the valuation as at 31st December 2011. Ignore taxation and liquidation costs. Show all workings. Identify any two limitations associated with each of the methods above.
All right, thank you very much, Angela. Yes, that is the question. Again, for the VS students, sorry, I didn't know that I've started calculation with you. But in any case, yes, let's solve the question together. You are asked to compute the value of Wazobia Limited. You want to determine the value of Wazobia Limited using price earning ratio. Like I explained to you last time, when you are valuing a company using price earning ratio, of course, the price earning ratio, market value of a company using price earning ratio is calculated as price earning ratio multiplied by earnings, okay? And I also told you that the price earning ratio is mostly suitable for companies that have profitable history, which means that any company that is profitable are the one that can use price earning ratio for the purpose of valuation. In that case, what that simply means is that any loss-making company or a company that does not, a company that makes loss cannot use price earning ratio for the purpose of valuation. And I also said that the price earning ratio is only available for quoted company. It's only a company that is listed on stock exchange that can use price earning ratio. However, if you now want to value a company, if you want to value an unquoted company, that is a limited liability company, like in this case, Wazobia Limited, you need to borrow the price earning ratio of a listed comparable company, all right? And in doing that, you must adjust the PE ratio of a quoted company. You must adjust the PE ratio of a quoted company between the ratio of 10% and 50% to account for the risk associated with an unquoted company, because a quoted company is less risky relative to an unquoted company. So if you want to value an unquoted company, a limited liability company, using price earning ratio, you must adjust the PE ratio of a quoted company. You don't use exact PE ratio, because if you use the exact PE ratio of a quoted company for an unquoted company, that means you are assuming that both companies have similar business risk, which is not true, because an unquoted company is more risky. It's more risky compared to a quoted company. So that is that. Let's go through this and solve using price earning ratio. All right. So let me stop sharing this and move to the working notes quickly. Again, sorry for the to the VI students. Sorry, I didn't know I would have gone for another question and make this one the last one. So that's, but again, that notwithstanding, let's move on. All right. So solution to illustration 2. That should be page 1, 2, 3. Let me check. Page 1, 2, 3. Yeah. Okay. So requirement number A1. I would then say valuation using PE ratio, price earning ratio. You know, like I explained to you when we are discussing the concept, the problem is not about the market value that you want to calculate, because the P ratio certainly will be given to you, or you calculate it. To calculate P ratio is just the ratio of share price to earnings per share. Of course, it will be given to you. The earnings, you are going to see profit after tax in the question, but the issue then is that you cannot use the exact earning given to you, because it will be too straight, it will be too cheap. So that earnings must have been distorted, because again, like I said, accounting profits usually can be manipulated, can be distorted. So as a result of that, like in this case now for Wazobia Limited, the directors pay a higher directors remuneration relative to what they should have charged. Then, of course, they also overcharge their inventory. All these things are techniques to manipulate results. Okay. So if that is the case, when you are valuing a company using price earning ratio, especially when you are writing ICAN exam, certainly you need to make adjustments on your earnings. Therefore, to calculate market value of a company using price earning ratio, all right, market value will be equal to price earning ratio multiplied by earnings. Okay, you can see it's straightforward. Just go to the question, bring your price earning ratio, multiply with earnings, and you get your market value. So like I said, it shouldn't be as straightforward as that. So in this case, we need to go and determine, because Wazobia Limited is a limited liability company, Wazobia does not have price earning ratio. So you need the price earning ratio of a comparable quoted company. All right. So I will then go to the question. What are the comparable companies given to us? We are given company A and company B, all right? So the P ratio of company 1 and 2. So the P ratio of company 1 is 5.4, P ratio of company 2 is 6.6. When you add the two together, it will give us total P ratio of 12. This is 5.4 plus 6.6. So we need to get the average. We then divide it by 2. This is 12 divided by 2. So the average P ratio in the industry is 6. 6 times. All right. So you cannot use this 6 to value Wazobia because Wazobia is a limited liability company. Therefore, we need to adjust this P ratio of 6 between the percentage between 10 and 50%. So I can then say adjusted PE ratio is equal to 6 multiplied by. Now, at this point, if examiner is not specific, you are at liberty to assume any percentage between 10 and 50%. I can decide to use 10. You may decide to use the 15%, 20%, 18%, 30%, even 40% or 50%. So whatever you think is the passive risk associated with the unquoted company is what you should use. But what is important is that at the end of your calculation, you are supposed to state your assumption. So let's use 15%. So if 15% is the risk associated with Wazobia Limited, that means we are supposed to account for 85%. So I would then come here, multiply by 85. That is 100%. That's 6. That the price earning ratio of 6 is 100% minus the risk associated with Wazobia, which is 15%. So that's how we got the 85%. So in this case, 6 multiplied by 0.85, what do you have there?
5.1.
5.1.
5.1 times 5.1. So the P ratio is 5.1. That's our adjusted P ratio. So you keep that one on one side. But before that, before we move to the earnings, you need to state your assumption. You then say note. The P ratio of comparable company companies of 6 has been adjusted to 85%, has been adjusted to 85%. That is 5.1 to account for the risk, for the perceived risk associated with Wazobia Limited. With Wazobia Limited, an unquoted company. Okay. So I've told the examiner the basis of my P ratio and the reason why I adjusted for the P ratio. Okay. So I need to go and determine the earnings that I'm going to use. So I need to calculate adjusted earnings or revised earnings. Let's go back to the question. According to the question, there are some information examiner has given us in relation to earnings. When you go to the table, the first table under B, when you go to the table under B, additional information B, you will see examiners, you are going to see profits given to you. Profit for the year, 3,250, 3,600, 4,175. That is the profit for the year. Ordinarily, we are supposed to add all the profit, the 3 profits together and divide it by 3 to get average profit. Profit is the same thing as earnings, right? So, but because there are some somersaulting accounting or creative accounting that have been done by the management of this company. So we need to make adjustment for those manipulation. So I will come here. We have 2009, 2010, and then 2011. Then, of course, we have total. Figures are in thousands. Okay, so profit for the year. So 2009 profit, according to the question, is 3250. 3250, 3600, then 4175. When you add the three together, what do you have? Give it to me.
11,025.
11,025.
Five.
So that's the total profit for the 3 years. Ordinarily, I'm supposed to divide that total profit of 11,025. I divide it by 3 years. So it will give me average. But you can't do that because before arriving at this profit, examiner told us in the question that it was discovered that inventories were overvalued at the end of 2008 by 600,000 naira. You know, when you overvalue your inventory, your gross profit will reduce. You know, in your statement of profit or loss account, the top line item is your revenue. From your revenue, you deduct direct costs. Inside the direct costs, you have your cost, you have your inventory. So if you overvalue your inventory, that is, you increase your inventory beyond normal, in that case, your profit will be low. Your gross profit will reduce as a result of that. So to correct these anomalies, what are you supposed to do? You cannot go back to 2008 again. So you need to make adjustments on the year immediately succeeding the previous year. 2008, 2009 is the year succeeding 2008. Therefore, that 600,000, you need to return it. So I will then come here, inventory overvalued or overvalued inventory. 600,000. 600,000. So that's the correction. Because you overvalue your inventory in 2008, your profit in 2008 was reduced. So to correct this, that 600,000, you return it on the 1st January 2009. So that's the correction you need to do for that. The next one, again, we are still on the same paragraph. You are now told that the directors have increased their remuneration in order to reduce the company's tax liability. Okay, this is very common among companies. Every company don't want to pay the right tax. So even though they may not want to, they are not trying to evade tax, but this is what we call tax avoidance. So they're trying to manage their cost structure to be able to pay minimum tax. All right, so they increase directors' remuneration for the purpose of reducing the tax liability, because once you increase your director's remuneration, your operating expenses or your operating cost will go up. If your operating costs go up, then it means that your tax liability, your profit before interest and tax will reduce. If your profit reduce, then your tax liability will also reduce. So that's the implication. The examiner now told you that a realistic charge for services rendered will be 1,875. So the company is supposed to charge directors remuneration of 1,875, but they end up charging 2,500 in 2009, 2,900 for 2010, 3,000 for 2011. So the difference between what was charged and what they are supposed to charge will represent the amount they are going to return. So in 2009, they charged 2,500 instead of 1,875. So I can say director's remuneration overcharge. Director's remuneration. This is overcharged because of space. Let me just remuneration overcharge. So in this case, it would be in 2005, for example, is a 2,500. They charge 2,500 instead of that place is too small. I want to use this just as an example. So they charge 2,500 instead of 1,875. So what's the difference?
625.
625. So this excess, you need to return it to your profits for each year. So in 2010, the company charged directors' remuneration of 2,900 instead of 1,875. What's the difference?
1025.
1025. In 2011, 3,000 was charged instead of 1,875. What's the difference?
1125.
1125.
1125. Okay, add up the three together.
2775.
2775. So that's that. Then we go back again to the same paragraph. The equipment is old and it is in need of replacement. The annual depreciation based on the current replacement cost is in the region of 3 million naira. So the company is supposed to charge annual depreciation of 3 million naira, but they end up charging a lesser amount. So instead of charging 3,000, the company charged 2,250. The company undercharged depreciation. So remember, in your profit or loss account, depreciation is embedded in your operating cost. So if you undercharge your depreciation, that means your profit will go up. All right, because you did not charge the normal depreciation, you charge less. So if you undercharge your depreciation, your profit will go up. If your profit goes up, that means you are going to pay a higher tax liability. So to correct this, we are supposed to find the difference between what you are supposed to charge and what you deducted at the end of the day. The difference, you are going to less it. Okay, so depreciation or undercharged depreciation. Okay, so the company is supposed to charge 3,000. They end up charging 2,250. The difference of 750, you are going to less it. 750 is the same thing for each year. The total is 2,250. What else? I think that's all. Let me see. Yes, that's that. So in this case, let's find the difference. Please go only for the total. I need difference for the total. I don't need for each year.
12,150.
12,150. That's the total earnings, total profit. Okay, so you can in your own case you can complete the table and find the total for each year. Okay. All right. So at this point, we have a total profit of 12,150 for first year, second year, and third year. I'm looking for average profits. So I would then say average earnings equal to 12,150 divided by 3 years. What do we have here?
4,050 naira. 4050.
4,050. So that's the total earnings. That's the revised earnings. So at this point, I can then go back to then say market value, therefore, market value of Wazobia using price earning ratio. We said is PE ratio multiplied by earnings. So the market value will then be equal to earnings of 5.1, sorry, P ratio of 5.1 multiplied by 4050. What do we have?
20,655.
655. Remember, our figures are in thousands. So I would then say, I need to write it out in full. I would then say the market value of Wazobia Limited using PE ratio is 20,655,000 naira. That's that. Then the second one, the second requirement says that number A2, you have to use liquidation basis replacement. Number 2 and 3, they are of the same category. They are from the same family. Liquidation basis, replacement value basis, they are under asset-based approach. So like I'll explain to you, we can match them together in a table. So we are going to match 2 and 3 together in a table. All right. So I can say 2 and 3. So here I will say market value, valuation using liquidation basis, using liquidation and replacement. Value basis. So we can use one table to do this. You know, there are 4 different forms of asset-based approach. We have the book value basis, replacement value basis, liquidation basis, and then realizable value basis. All of them, you can categorize it in a table. You can rank everything in a table. Of course, your final analysis, you can then be picking them one by one to express your value. So I will come here. The first one is liquidation value. Then the second one is replacement value. So we said that the value of a business using asset-based approach represents its net assets. So you are supposed to calculate the net assets under each of them. And the net asset is the difference between the total tangible assets and then total liability. So I will then go to the question. I will go to the question, under asset-based approach, are we given any figure? Let's go back to the balance sheets. What are the assets given to us in the balance sheets? The first asset we have in the balance sheet is freehold properties. Freehold property, the book value of the freehold properties is 6,500. So under liquidation, freehold property is given as 15,000. Under replacement is also given as 15,000. Okay, so I will come here freehold properties, 15,000. Then 15,000. What's the next asset from the balance sheet?
Equipment.
The next one is equipment. Okay. In the balance sheet, what's the value of equipment?
15,600.
2,000 what?
15,000.
600.
Okay.
Less depreciation.
Under the liquidation, how much is equipment?
15,000.
Under liquidation,
5,400.
5,400.
5,400. So
Sorry.
equipment under liquidation is 5,400. Under replacements, what do you have?
8,650.
8,650. Then after equipment, what's the next one?
Inventories.
Inventory.
So we also have inventory. Under liquidation, how much is inventory?
8,000.
8,000.
Under replacement,
4,350.
4,350.
after inventory, what else?
Receivables.
Receivables.
Receivables. Under liquidation, how much?
4,825.
4,825.
Then under replacement,
4,825.
4,825.
is that balance sheet number of figures given to you in the under each of them?
Balance sheet figures.
Okay, so in the table, this is what I'm saying. In the table for replacement and liquidation values, you're only given 3 line items: freehold properties, equipment, and inventory. So any cost that you don't have, any asset that you don't have under the replacement and liquidation, you are going to use the balance sheet figure. Okay, so we don't have receivable under replacement and liquidation, and that's why we are using the historical value. That's it, we are using the book value. So 4825. Then what else after receivable?
Cash equivalent.
Cash. How much is cash?
650.
625. 650.
650. Okay. After cash, what else?
Total, sir. Total tangible assets.
Okay, then. So since we don't have other assets, then we need to add up. Add each of them.
For liquidation, 33,875.
33,875. That's the total tangible asset.
33475. 475.
475 for replacement. So this represents total tangible. Remember, we said that when you are valuing a company using asset-based approach, intangible assets like goodwill, patent rights, copyright, etc. should be ignored except they have a market value. If you are given a market value of the intangible asset, you need to add it to the tangible asset. But if you are not given market value for each of them, then you ignore. Okay, so I will then go back to the question and pick total liability. In the question, we're only given current liability. So how much is current liabilities?
4,150.
4,150.
4150. The minus.
The same
Wow.
thing.
Okay. So what's the difference?
For liquidation, 29,725.
29,725.
29,325.
29,325. So this give us the net asset. This is the value we are looking for. Remember, we said that the value of a company using asset-based approach represents its net assets. So value is equal to net asset. And net asset is the difference between total tangible asset and total liability. So number 2, I can then say the value of Wazobia Limited the value of Wazobia Limited using liquidation basis. Liquidation value basis is 29 million 725 725,000 naira. So that's that. Then I will then go to the third one. Number 3. The value of Wazobia Limited using replacement value basis is 29 million 325,000 naira. So that answers requirement number A3. All right. So we are moving to requirement number 4. Requirement number A4. An examiner is asking us to use dividend yield basis. Okay, you have to use dividend yield basis. So in this case, we said that the value of a company using dividend yield basis represents the market value or the present value of future cash flows discounted at dividend yield or cost of equity or rate of return on equity of the company. All right. So in this case, using, I will say, valuation using dividend yield basis. So we have done this. This is the first one we solved today. So the market value using dividend yield will be equal to, in the question, we are not given anything like growth rate. So I can say market value is equal to dividend over dividend yield. Remember, dividend yield is the same thing as cost of equity. So since we are not given growth rates, this is the formula to use. So I will then go to the question, what is the dividend of Wazobia? How much dividend was paid by Wazobia?
2,250,000.
Okay, so from the table given to us, dividend is 2,250,000 for each year. So since dividend is constant between 2009 and 2011 is the same dividend paid. Therefore, that means there is no growth. So here will be 2 million. Here will be 2,250,000. Figures are in thousands, so write it out in full here. Divided by the dividend yield. So in the question, we are not given dividend yield for Wazobia, but we are given dividend yield of comparable company to be 9% and then 11%. So we just find the average dividend. So I will just say notes. Average dividend yield. So the first one is 9% plus 11%. Then because there are two companies, you divide it by 2. So the average dividend yield is 10%. That's 20. Let me just say 20 divided by divided by 2, which is equal to 10%. So here divided by 1, 0. So what do we have? This will give us
22,500,000.
500,000. So I can then say the value, the market value of Wazobia Limited using dividend yield is 22,500,000 naira. That's that. It's as simple as that. This is how to carry out valuation. Even in practice, it's the same thing. Of course, when you are doing this in practice, you just need to make some assumptions, especially if you are using cash flow based approach. All right. So the number B part of the question, examiner is asking you to identify any limitations associated with each of the methods above. Let's do it this way so that we can solve one more additional illustration. I will share the solution to B parts, but one thing is common to majority of them is that one of the limitations is that especially the P ratio, the liquidation basis, the replacement basis, they don't consider time value of money. They do not take into consideration the time value of money. All right, that's one limitation. Of course, price earning ratio is majorly used by companies that have profitable history, which means that any company that does not that is making loss, a loss-making entity cannot use P/E ratio for the purpose of valuation. These are some of the limitations, all right? These are some of the limitations. Like I said, I will share with you later on. Okay, so let's move to one more illustration before we close the class. So what that simply means is that we cannot even finish because I would like us to solve more. I don't know where examiner will come out to you. So yes, Temitope, what's your question? Talk to me.
Yes, sir. Please, while you were solving for the adjusted P ratio, you mentioned something about the perceived interest of 15% and 10%.
Perceived risk.
Okay, risk rather, perceived risk of 15% and 10%.
Yeah.
And then we later use the 15%. So I really
Yeah.
do not understand what that is about.
Yes, in my explanation, I said that when you are valuing an unquoted company, using PE ratio, you need to borrow the PE ratio of a comparable quoted company. So when you are using the PE ratio of a quoted company to value an unquoted company, you need to adjust the P ratio downwardly between the ratio of 10 and 50 to account for the risk associated with an unquoted company, because the risk of an unquoted company is higher relative to a quoted company. So you cannot use the same P ratio of a listed company for an unlisted company. So, and I said the ratio that you are going to adjust for will depend on what you think is the perceived risk. Every student will have different answers. When you are valuing the business using price earning ratio, student cannot have the same answer, except that if examiner wants you to adjust the P ratio, you are given a specific percentage. That's only when everybody will have the same answer. Because I may decide to use 15%, you may decide to use 18%, and that student may use 40% as the percentage. Whatever you think is the risk associated with an unquoted company is what you are going to calculate for, and that's what the examiner will mark for you. But what is important is that you just have to state your assumption. Whatever you have assumed as the perceived risk, you have to state it in your answer booklet. Is it clear, Temitope?
Yes, sir. So the percentage is between 10% to 50%.
Pardon?
I said the percentage is between 10 to 50%, right?
Yes.
Okay, sir.
So in
Thank you.
between 10 and 15, in between 10 and 50, whatever you think is what the examiner will mark for you. Yep.
Okay, sir. Thank you, sir.
You're welcome. Yes, let's have one more illustration before we close the class.
Sorry, sir. I
Anissa,
have one question.
yes, talk to me.
So this rule is only applied to unquoted company. So what if in a situation where we are being given quoted company, we're not going to use the rule, and what do we do?
If you are valuing a quoted company, if you are valuing a quoted company using P ratio, you don't need to adjust for anything. Do you get?
Yes, I understand.
So you don't need to adjust. If you only adjust if you are valuing an unquoted company. All right?
Okay, thank you.
You're welcome. Yes, I need somebody to help us. Oh yeah, Treasure, read illustration number 3. Since I just finished speaking with you, so
Okay.
we want to hear your voice.
Lamborghini Limited, a food packaging company, has operated as a private company for the past 10 years. The company has been growing rapidly over the last few years. The directors are now considering listing the company on the stock market. Preparatory to this, the directors are interested in determining a fair price per share for the company. Assume today is November 1st, 2016. The following information has been extracted from the most recent audited financial statement of Lamborghini Limited. You have your statement of profit or loss as at 31st October 2016, sales revenue, cost of sales,
Leave those ones.
earnings before interest, tax, depreciation and amortization,
Leave those
depreciation,
ones.
EBIT. Okay. Okay, you can scroll up then. Statement of financial position. Okay, scroll. The following additional facts are available. Yes, I can scroll. That's fine. The directors believe that the free cash flow to equity model should provide appropriate valuation for the company's shares. An investment banker has provided the following estimates of cost of capital: cost of equity at 15%, post-tax cost of debt at 4%, WACC 12.5%. The directors believe that the free cash flow to equity will grow by 18% for the next 5 years and by 5% thereafter. The company currently has 600 million shares in issue. Required: calculate the free cash flow available to equity for the year ended October 31st, 2016. Use free cash flow to equity model to calculate the current value per share. C. What are the key advantages and disadvantages of stock exchange listing?
All right, thank you very much, Troya. So that is the question. Number A, requirements. Examiner is asking you to calculate free cash flow available to equity for the year ended October 31, 2016. Recall when I was explaining to you last time, I said that free cash flow represents the cash flow available for distribution to providers of capital after taking into consideration all relevant expenditure, including operating expenses and capital expenditure. All right, so the free cash flow is available to be shared between the debt holders as well as the shareholders. And I said there are 2 types of free cash flow. We have free cash flow to the firm. We also have free cash flow to equity. The free cash flow to the firm is the cash flow available for distribution to shareholders and then the debt holders. All right, and it is suitable for determining the value of a company, that is corporate value. You use free cash flow to the firm to calculate enterprise value, or what we also call a corporate value. Then the second one is the free cash flow to equity. We say free cash flow to equity is the cash flow available for distribution to equity holders. It can be used. The free cash flow to equity is useful for determining the equity value. Is used for calculating equity value. All right. So in this question, examiner wants you to calculate free cash flow to available to equity. All right, so this is not free cash flow to the firm. We are supposed to calculate free cash flow to equity. And I gave you 3 different formats that you can use to calculate free cash flow to equity. Depending on the information given to you, any of the formats will be suitable to do that. Now, let me stop sharing this quickly and move to the working notes so that within the next few minutes, we are done with our calculation. All right, so we want to calculate free cash flow to equity. This is solution to illustration 3. That should be page 124. Let me confirm. What page? Okay, that's page 124, I think. Yes. All right. So the name of the company is Lamborghini Limited. So we are told that Lamborghini is going for stock exchange listing, and you want to determine the value of the business. The first thing first examiner wants you to do is to calculate the free cash flow to equity. So you are required to calculate free cash flow to equity. How do you do this? All right. How do you calculate free cash flow to equity? Remember, like I said, I gave you 3 different formats that you can use to calculate free cash flow to equity. So whenever you want to calculate your free cash flow, first thing first, you need to go to the statement of profit or loss account. You check, are you given profit before interest and tax, or you are given profit after tax? If you are given profit after tax, that one will be faster. So you just select your profit after tax. It is also possible in the question that examiner may not give to you profit after tax. You may be given profit before interest and tax. So if that is the case, you use that one to solve it. All right. However, examiner, it is also possible examiner might have calculated free cash flow to the firm, and you are now asked to calculate free cash flow to equity. How do you compute it in that instance? So I gave you 3 different formats. So without wasting more time on this, within the next few minutes, let's complete it. We want to calculate free cash flow to equity. So in the question, you can see profit after tax of 1054. So that's the method we are going to use. I will then say calculating free cash flow to equity. Free cash flow to equity. Our figures are in million. All right, so according to the question, we are given profit after tax of 1054. Okay, now, before arriving at profit after tax, the company has deducted interest expense, they have paid tax and all of that. So because interest has been deducted, you need to add back the interest. Okay, now that is, you only do that if you are calculating free cash flow to the firm. Now, since we are calculating free cash flow to equity, so you just pick your profit after tax straight, then you add back non-cash item. You consider changes in working capital. You consider if there is any capital expenditure. All right. You consider if there is any loan repayment or proceed from debt issues. All these things, just go to the question and be looking for the variables. Anyone you don't have, you ignore it. So in this question, we have depreciation of 440. So let's add it back. So I would then say depreciation, non-cash item. It's a format. Here is 440. You had it back. After depreciation, you consider changes in working capital, we said that if working capital increases, that means cash has gone out, so you minus. Then again, if working capital has reduces, then that means more cash has come in, it's a plus. All this you need to know how to treat it. So I will then go to the question. The reason why I want us to solve this question is because anytime you want to compute your working capital, you need information about the statement of financial position. So if you are given two different periods, like in this case, we are given information on 2016 and 2015, that means you need to watch out for movement in working capital. You need to watch out for movement in working capital. So in this case, let's go ahead and let's go and calculate changes in working capital, because when you look at the balance sheet given to us, the working capital, the movement in, when you go to under current assets, we are given cash and bank, you are given account receivable, you are given inventory, and they are not the same amount. Since they are not the same, there's difference between the 2 years. So in that case, we need to go and calculate changes in working capital. So without going too far, let me see. Let's do our working here. For this number A part, let's do our working here. Working number 1, we want to determine changes in working capital. Okay. So we have 2016. Oh, let's start from 2015. We also have 2016. Then we have the change, what has taken place. Our figures are in thousands, are in million. So give it to me, please. In 2015, how much was inventory?
In 2015, inventory was 2078. 2078.
2078. In 2016,
2542.
2542. Pay attention. In 2008, our inventory was 2078. It has increased to 2542 in 2016. What's the difference?
464.
464.
92.
That means
Okay. 464.
464.
460.
464. So in 2008, we bought inventory of 2078. In 2016, it has increased to 2542. That means more cash has gone out. So you put it in brackets. Then after inventory, what else?
Account receivable.
Accounts receivable. So in 2015, how much?
980.
980. Then 2016,
1072.
1072. What's the difference?
92.
92.
92. Again, in 2015, your receivable is 980. Now it has increased to 1072. So this also an increase. Then after receivable, what else?
Well,
Now, please, when you are calculating, you can see we have bank and cash and bank. So when you are calculating changes in working capital, you don't consider cash. No, don't consider cash and bank. So you have to ignore that. Okay. So if that is the case, add the two together, what do you have? Now, before that, let's go back again. We also have account payable, right?
Yes, sir.
Under liability, we have short-term loans. Short-term loans is not a working capital. It's under, in a statement of cash flow, where statement of cash flow is categorized into 3. We have cash flow from operating activity, cash flow from investing, and cash flow from financing. So short-term loans is under cash flow from financing. So it shouldn't fall part of operation. So we are going to use that one later. Then we have account payable. So in 2015, how much was account payable?
2792.
2792.
2792.
92.
2792. Then in 2016, what do we have?
3084.
3084.
3084. So you were owing somebody, the company was owing 2792 in 2015. Now the company has borrowed more, has owing more. It has increased to 3084. So what's the difference? That's a
292.
plus. 292.
292.
So that's a plus. More cash has come in. More cash has come in. So this is what we have there. Then we need to calculate the total. I need the total for the change. I'm less concerned for under each year. So just give me total for the change.
264 negative.
Minus 264.
264 negative. That's increased in
Negative.
working capital. That's increase. Our working capital has increased. Changes in working capital. So I can then go up there and indicate it. 264 negative. We have increase in working capital. So here is changes in working capital. Working number 1, 264 minus. Then after changes, we have a format. After changes in working capital, we also need to consider if additional non-current asset has been purchased. So how do we determine if additional working capital has been purchased? You remember under cash flow statements, to know if additional working capital, if additional non-current asset has been purchased, that would be under investing activity. So in this case, let's go and do working for that. Let's go and do working to determine if additional non-current assets have been purchased. So working number 2, additional non-current asset or capital expenditure. Okay, so we want to know if additional non-current assets have been purchased. There are 2 ways we can do this. We can either use formula or we use a T format. If I want to use a T format, right? So non-current assets, asset is a debit balance. Therefore, I will say balance brought forward. Then we are going to have balance carry down. Then we consider P&L, profit and loss accounts. Under the P&L, we have depreciation. Then, of course, we are going to have addition here. So in 2000, balance brought forward in 2015, how much do we have as non-current assets? In 2015, how much was non-current assets?
5942.
5942. Here is 5942. Balance carried down in 2016, 2016. How much was
224.
6,000?
224.
No, 6224.
6224.
Yes.
Yes, 6224.
224. All right. So how much was depreciation? 440.
440.
So give it to me. Add it up. 440 plus 6224.
6664.
6664.
64. Okay. minus 5942.
722.
722. So that means the company has purchased additional non-current assets worth 722 million. Okay, so here is 6664. Alternatively, if I don't want to use T format, like I said, I can use a formula. I will say addition equal to the closing balance, closing non-current assets plus depreciation minus opening non-current assets. So in this case, here will be 6224, 6224 plus 440 minus 5942. So we have 722. Okay, so let's go and post. Additional non-current assets, or you call it capital expenditure. All right. That's working number 2. We got 722. So cash has gone out. It's an addition. Now, after capital expenditure, you need to check from the question if there's any loan repayment, as you want to know if the company has paid loan or the company has borrowed more loans. So to do this, we are going to consider this will be considered under the financing cash flow from financing. So we need to consider cash flow from financing. So let's go and make our adjustment to know if additional loan has been borrowed or a company has paid loan. Now, you are not just going to do working. First thing first, you need to go to the balance sheets. You go to the balance sheet and check from the non-current liability if there's a movement. So we have a movement in the non-current liability. Then we also have a movement under short-term loans. So we need to, there's an adjustment to be made. So working number 3. We want to know if additional loan have been borrowed. So I can just say loan. Additional loan or payments. Whichever one. I don't know which one for now, so I'll just call it additional loan. If you borrow additional loan, it means that more cash has come in. But if you pay loan, that means cash has gone out. Again, we can use T format for this. We can use the same format that we use for changes in working capital. So I will come here 2015. 2016, then change. Our figures are in million. So in 2015, according to the question, we have non-current liability, 2,500 in 2015. Non-current liability so in 2015 is 2,500. In 2016, how much was non-current liability?
2,400.
2,400. Here is 2,400. Before, you were owing somebody 2,500. Your owing or your debt has now reduced to 2,400. 2,400. That means you have paid back. Your loan has reduced. The loan that you borrow has reduced to 2,400. That means you have paid back 100. So in this case, cash has gone out. Then I will go back again to the balance sheets. What other information on financing do I have? So we're also given short-term loans. All right, we have short-term loans. So in 2015, how much was short-term loans?
1432.
1432. In 2016, how much?
1936.
1936. So your short-term loan in 2015 was 1432. In 2016, it has increased to 1936. That means the company has borrowed more loans, more short-term loans. So what's the difference?
504.
504. This 504 is a positive because more cash has come in. The company has borrowed more money, so more cash has come in. Therefore, find me the difference on the change.
404.
404 positive. So that means there is additional loan. Additional loan. Positive. So let's go and account for that. 404. Additional loan. $404. All right. So that's all. That's all. In this case, let's find the difference. Give me the final answer. What do you have? Add it up.
912.
912. So 912 represents the free cash flow to equity. This is the free cash flow to equity. That's what the examiner asks you to do. Now, this 912 is the current value. So you have to calculate free cash flow available to equity for the year ended 2016. 2016 is the current year. So number B, you are required to use free cash flow to equity model to calculate the current value per share. So you want to calculate market value. Then how do you calculate market value? Using cash flow. How do you calculate market value? Using cash flow. Of course, to get the market value, you are supposed to use, remember, I said that using discounted cash flow basis, the market value, the valuation relies heavily on the use of free cash flow, and it should be discounted using like in this case now, since the company is going for stock exchange listing, so all you need to do is to just discount the free cash flow to equity using the current WACC of the company. So I will come here, calculating, we're almost done, calculating market value. All right, figures are in million. Now, I need to go back to the question. I need to ascertain what's the initial period in this question. What is the initial period? Examiner is telling you that the directors believe that the free cash flow to equity will grow by 18% for the next 5 years. So the current free cash flow to equity of 912 will grow by 18% for the next 5 years. That means the initial period is for 5 years. So I would then say year 1, year 2, year 3, 4, and then year 5. So the current free cash flow to equity is, we calculated 912, and we are told that this 912 will grow by 18%. So 18% plus 1 will give us 1.18. Therefore, for year one, please, I need everybody to participate in this one so that you don't, if you press your calculator, you are going to, you follow through so that you understand how we are doing it. So you pick. Examiner told you that the free cash flow will grow by 18% for the next 5 years. So 1 plus R, 1 plus G, 1 plus G will give you your 1.18 because our growth rate is 18%. So you then say 1.18 multiplied by 912 equal,
1076.
that's 1076, 1076. So what you have in your calculator multiplied by 1.18, that's 1270.
1270.
1270. So what you have in your calculator multiplied by 1.18,
1498.
1498 multiplied by 1.18,
1768.
1768 multiplied by 1.18,
2086.
2086. So with this, we have grown the free cash flow. The next thing we need to do now is to now discount the free cash flow using appropriate cost of capital. So I need to go back to the question. What cost of capital am I using? In the question examiner has given us, you are told that an investment banker has provided the following estimate of cost of capital. Cost of equity, 15%. Post-tax cost of debt, 4%. WACC, 12.5%. So because you are calculating free cash flow to equity, so you have to use apple for apple. So you have to use cost of equity of 15%. Okay, so I would then say at 15%. So 1.15 raised to power minus 1. What do you have? Discount factor for year one.
0.870.
870. Next,
0.756.
756. Next,
0.58.
0.6.
0.75.
0.
0.657. I don't see why.
0. What?
658.
657.
You are confusing yourself, not me.
6575. Okay, that will be 658. Yes.
658.
Yes.
0.572.
658. 572.
0.49.
0.497.
497. So give me the present value for each year.
For year 5,
Yep.
1,037.
Okay.
936 for year one.
All right.
For year 2, 960.
960.
For year 4, 1011.
Okay. Year 3.
986.
986. So we need to add. Remember, I told you that when you are using cash flow for valuation, there will be 3 stages of your valuation: the initial period and then cash flow to infinity. All right. You need to determine terminal value. So for the initial period, we have done the initial period is for 5 years. So add up the PV for year 1 to 5. What do we have?
4,930.
4,930. So that's the PV of the initial period. So in addition to this, you also need to calculate PV of the terminal value, that is PV from year 6 to infinity, because company is seen to be operating on a going concern basis. So you need to determine the value of the business on a going concern basis. Yes, okay. Okay, what's your question?
Good evening, sir. How did we get for year 2 to 5, please? I know how we got the one for year 1, but I don't know how we got for year 2 to 5. That's the
What?
FCFE.
How we got what?
Year 2 to 5, that's the figure before the discount factor. 127014981768.
Maybe I told you that time to bring out your calculator to follow.
With my calculator, sir, I'm with it.
And we started from 912 multiplied by 1.18. It gave us 1076. Then you multiply what you have in your calculator by 1.18. You know, with this cost of capital budgeting now. So you should be right now, all these things should be flowing in your memory. You know, it's the same thing now. All those things we did under inflation, capital budgeting. So to get the second year, is this what you have in your calculator multiplied by 1.18. To get the third year, what you have in your calculator multiplied by 1.18. That's how you are going to do for all of them. Okay? Okay. Try it now. Let me know if you try it. Let me know if you get it.
Yes, I've done it already. It's clear.
All right then. So like I said, you need to calculate present value to infinity. That is after the initial period. After year 5 is year 6. So we need to calculate present value from year 6 to infinity. This sign simply means that's infinity symbol. All right. So I would then say free cash flow to equity of the base year multiplied by, examiner has given us in the question, we are given growth rates after year 5. We are given growth rate after year 5 to be 5%. Okay? Growth rate after year 5 to be 5%. Therefore, I would then say 1 plus G, 1 plus growth rate divided by cost of equity minus the growth rate multiplied by discount factor of base year. All right? So the PV of year 6 to infinity will then be equal to, the base year is year 5. So free cash flow to equity of year 5 is 2086, 2086. That is the figure that you have here. That's the free cash flow to equity of the base year. This is the free cash flow to equity of the base year. You are using year 5 cash flow to project to infinity. All right. Then the growth rate after year 5 is 5%. So 1.05 divided by cost of equity of 15%, 0.15 minus growth rate of 5% multiplied by discount factor of the base year. This is it here, which is 0.497. Multiply by 0.497. Give it to me. PV of year 6. Let me rewrite that. You can see financial management is very interesting if you know what you are doing. PV of year 6 to infinity will then be equal to, what do you have there?
10,886.
10,886.
886, yeah.
Okay, this is 10,886. Add it up. Add it up to the first one. Plus 49.
816.
Pardon?
15,816.
816. So this represents the total market value, that is present value of Lamborghini Limited. This total market value. Remember, examiner asks you to calculate current market value per share. So to now get I don't have space again. Let me just manage it. So the current market value per share, current market value, let me write it. Market value per share will then be equal to the total market value of 15,816 divided by number of shares. What's the number of shares given to us? We are told that the company currently has 600 million shares. So divided by 600 million shares.
26.36.
26.3.
36.
All right. So the current examiner is asking you the question to use the free cash flow to equity model to calculate the current value per share. So I would then say the current value per share is 26 naira 36 kobo. That's
36
it.
kobo. Gbogbo
That's
ta ṣe yìí
it.
fún 5 marks. ICAN ti bàjẹ́ o.
You're on your own.
Why na so the thing pay you?
You're on your own. So that's that. That's that. So this is how to value a company that is going for stock exchange. Of course, at times examiner may want you to use free cash flow to the firm. Again, it's still the same thing. As we are still going to have more illustrations. But what I will do is that your exam is 20 days now from today. 20 days from today. So uh let's see. Let's see. Let's see. What I will do is that I will share a video with you for the scenario 1, scenario 2, scenario 3. Again, like I said, at this level, ICAN cannot be asking you all of that, but then you can't predict because we have seen in the past whereby ICAN even went beyond your syllabus scope and the test test students. So anything can happen, but it's good to have. All right. So, but for now, let's call it a day. Let's call it a. Let me know if you have any question for me. Somebody sent a message. What's that? How did we get the figure? Oh, okay. I think that's okay. Yeah. Okay. So let me know if you have any question for me so that we can close the class. Some of you have disappeared. That's okay. It's understandable. Yes, David, what's your question? Talk to me.
Yes, sir. Please, I have one small question.
Pardon?
I said I have a small question. Please,
Yes,
the
talk
first
to me.
one we calculated maximum price for
Yeah.
Michelin that we paid to Dunlop. So, is it the price that Michelin we paid to merge with Dunlop, or like what's the price for?
When you make an offer, it's not for free. You also need to pay the shareholders of the company that you want to. So the price that the Michelin Bank will pay to the shareholders of Dunlop is the maximum price. You can't pay more than that. The current value. Let me go back to the question you are referring to. Okay, this is it. Yeah. So examiner is asking you the question to determine the maximum price that the that Michelin Bank will pay to Dunlop. Yes, maximum price Michelin Bank PLC will pay Dunlop Bank PLC. And we said that the maximum price that the acquiring company or the predator will pay to the target company will represent the difference between the post merger. When you combine the two companies, the value of the combined companies minus the value of the company that make the initiative is the maximum price that the Michelin Bank will pay. Because according to the question, the examiner told you that Michelin has made an offer. Let me go back to the question. Yes, the board of Michelin Bank PLC is considering making an offer to Dunlop Bank PLC. The offer is to take the form of merger on a share-for-share exchange. All right. So it's just the value that the Michelin price, the price that Michelin Bank will pay to Dunlop. That's what the examiner is asking. Maximum, you can't pay more. That is the maximum. That is the maximum. The current value, according to the question, we are told that the company has managed to increase its capital base to 10 billion. That is, Dunlop Bank capital base has increased to 10 billion. So that's not even what the examiner is asking you. So To get the maximum price, it's just the difference between the post-merger market value and the pre-merger market value of the predator. All right. So that's the maximum, which is 12,260. 12,260,000,000. Yes,
Sorry, sir.
David, is it clear?
So what I'm asking is, yes, what I'm asking is, are they going to pay them before
Of
or
course, now it's
after
not
the
for
merger?
free now. See, it's like I mentioned to you the other
Then
time. If it,
why we not using post-merger market value to calculate the maximum price? Because to get the maximum price, you're getting the figure after the merger. Meanwhile, you want to pay them before the merger. How does that work?
before you pay, won't you determine your value? That's what I was explaining to you the other time. Before you begin anything, I want to know, as of today, what is your value? As of today, what is my value? If we now we want to know whether there is going to be any synergy. So if I now match together, what will be my value? What when after we match together, my value is the post merger market value. So versus my value before I even acquire you or I match with you. So in valuation, you must determine the pre-market value and the post-market value to know whether it will result in a synergy or additional value being created. Do you get?
Okay. Yes, sir.
Yeah. So, yes, sir. You raise and talk to me.
Yes, sir. Sir, I want to ask that in a case whereby the examiner asks us to calculate for free cash flow to the firm, are we to use WACC as our discount factor?
Yes, yes, yes.
Okay,
Don't
sir.
worry, we are going to, I will see what we need to solve one more. We have two options. We have two options because I know your exams is fast approaching. Your exam is in the next 20 days. And the weekend, for example, is very important for you from this moment on. And that's what I decided to combine all of you today so that you can maximize the free period you have on weekends, Saturday and Sunday. If you can read very early in the morning. When you wake up very early in the morning, push your books before you go out. You can read till like 7 a.m. Then go ahead, take your shower, then go to the library or go to the center. For those of you that are attending physical classes, so you can go to the center and or you go to a library from 9 o'clock in the morning, from 9 o'clock in the morning till the evening, around 6 o'clock. Or once you are done, by the time what you are going to cover between that period, in fact, you will love it. You will love it. So for those of you that will go to the class to go and study, I will advise you don't stay in your at skills, don't stay in skills level classroom. You can go to foundation or go to professional because if you stay in your class, there's likelihood that you are going to see one of your colleagues in the class that will be distracting you. So if you don't want any distraction, then go and hide yourself somewhere. All right. So hide yourself somewhere and be studying hard because you need time now, especially if you are still going to the office. Some of you are very lucky. Maybe you have about 2 weeks study leave or a week study leave. Some of you is that your company may give you just 2 days or few days for study leave. So it's not the same thing for such people. For such students that doesn't that don't have sufficient study leave, then you need to maximize your Saturday and Sunday studying, reading, and that's why we are saying that of course officially lecture has ended, but because there are some lecturers that still have one or two areas to cover, and that's why um, effective from this weekend, you need to maximize your time, and you need to maximize your time. So what I will do is that we have two options available. Uh, I've done. Let me scroll down a little bit. For I've solved illustration number 4. I've solved this illustration number 4 is scenario number 3, sorry, number 2. I've solved it. I've also solved illustration number 2, sorry, illustration number 5, which is scenario number 1. Then uh, I've solved illustration number 6, which is scenario number 3. So I'm going to share those videos. I just solved it recently. There are a few about a week ago or thereabouts with professional student, because it's the same thing. All right. So I can share the video with you, so you'll be able to listen to it, how we treated those things there. Then if you have any question, you can ask me, or we can meet again on Saturday. So to discuss to solve the three of them together if you want that. But you need time. You need time. Your exam is fast approaching. You need time to study. All right. You need time to study. So that will be that for today. Let me know if you have final question for me before I say bye-bye.
Excuse me, sir. Good evening, sir.
Yeah.
So are you
Yes,
saying that the
Joyce.
physical classes have ended?
Yes, because lecture ended October 26th, last Sunday. But there's, like I said, there are one or two lecturers that still have. I don't know if Mr. Ibrahim is done with you in solo. So then again, Mr. Abe. So tax is done with you. So and
No, I was asking about FM.
so of course now. So yeah, that's it. I believe Mr. Shiwajuli is done with you. So he told me he's done with you, isn't it?
Yes. Yes.
So yeah. So I'm also done with you. Like I said, I just want to give you additional illustrations, and that's what I said. I
Okay.
will share the video with you. So class has ended, right?
Okay, sir.
All right. So in the absence of no further question, I want to say thank you to every one of you for joining the class. Bye-bye and then good night.
Thank you, sir.
You're welcome.
Sir, good night.
Thank you, sir.
Angela,
See
good
you in
night.
the exam hall.
I'm not one of the invigilators. Don't worry. We are still going to talk more now. So we still relate in the groups. All right.
Thank you, sir.
You're welcome.
Good night.
Okay. Yeah, good night.
Good night.
Good night.